have a question.
Yes, sir.
It's not that often that we take on a stock sale, and I may have an opportunity where, and I think you and I just touched base on it. But what is the key drivers or differences between, say, a stock sale and an asset sale?
So when you're using an asset purchase agreement, the buyer is buying the assets of the business, and typically the liabilities remain with the seller. So any accounts payable, any debt that's owed, let's say there's any loans that are out on the business, or secured by assets of the business, all of those have to be paid off through escrow so that the seller can transfer clear title to the assets to buyer. Okay. In a stock sale, they're buying the whole balance sheet, assets, liabilities, the whole balance sheet is so the and what concerns people the most on small businesses is that it's not the known liabilities. The known liabilities are what you can see on the balance sheet. It's the unknown liabilities, right? So it's what's not on the balance sheet, or if the sellers have been playing games with their tax returns the way a lot of small business owners do, then it becomes potentially the buyer's liability. Let's say somebody buys the stock of a business, of a corporation. They buy the stock of the corporation, they're operating it for 2 years, and now they get an audit notice from the IRS on tax returns that were 3 years ago or 4 years ago. And they should have copies of them because all the records should be in the corporate office and all that. But nonetheless, if the seller had been running all kinds of nonsense through the business and they end up getting hit with penalties and interest and all of that, the only recourse they have is to go back in. The purchase agreement always has indemnification. And so the seller is responsible for any claims and issues that arose during his ownership. But if you're 2 years down the road and you get audited and you get a tax bill for $50,000 and you go back to the buyer and say, hey, this is your tax bill, you owe. I mean, good luck collecting it. It becomes a challenge. So it's rare that we do stock sales for small businesses in California, primarily because of the unknown liabilities. But there are instances where you do need to do that. And that is where there's a Medicare number, Medicare billing number or Medi-Cal that needs to transfer and can't transfer any other way. Or let's say like durable medical equipment, retail stores. That's where I first learned about this Medicare and Medi-Cal stuff. And I was selling a DME, and there are people out there that's all they do is set up DMEs because you have to rent a space. Then you start the process of trying to acquire the Medicare billing number. Well, that process takes 2 years. So if it takes 2 years to acquire that number, can you imagine buying somebody's business? And why would you buy somebody's business and then basically not be able to bill anything to that Medicare billing number for the next 2 years until you acquired your own, right? Nobody's going to buy that business. So there are circumstances, same thing with government contracts. I was selling a manufacturing company. They were doing a lot of work for Department of Defense, and and so they had a what's called a cage code, and all their government contracts were long-term contracts with the corporation. And so if there was under an asset purchase agreement, the corporation would no longer have those contracts because it would be the buyer's new entity. And so at that point, all of those long-term contracts would go out for rebid. So the only way that you can actually sell that is to sell the stock, because that way the corporation doesn't change, the cage code doesn't change, the employer ID number doesn't change. All of your taxes and everything else get filed under the same accounts, the same numbers. So there's no real change. There might be some authorizations that you need to get, but in general, it's much easier to transfer. And what's really interesting is, like, up in Canada, probably 98% of the transactions they do in Canada are stock sales. They're always selling stock.
Why is that? Is it because of the
Because
licenses or
taxation. So up in
taxation?
Canada, it's far more tax advantageous to do a stock sale, or to sell the entity. And where here, and they're not as litigious. I mean, litigation in the United States is crazy. People make a living, and I'm not talking about attorneys making a living. I'm talking about just individuals. There are a lot of individuals out there that just make a living by suing other people arbitrarily, just so they can settle and squeeze money out of them. So it's unfortunate, but just our laws, I guess, permit that in certain respects.
So
So
ideally, a situation is here for us to take on a stock sale is something that requires some sort of licensure, for example, because of the time that it takes to transfer these licenses, maybe some liabilities that are part of this as well as manufacturing as well too, right? I mean, that's something,
usually it's contracts. So there are contracts in the entity name.
okay.
So, like, for example, even with a construction company, you might have the
Yep.
license, the contractor's licenses might be in the name of the corporation. So you might do a stock sale for that reason, because they want to keep that license number, because maybe that license number is really old. Maybe that license number is 30 years old, and so it's a lower number than what they're issuing today. And so the business has more credibility because it's got that older number. I mean, there are a lot of reasons. Um, but
Yeah.
it just depends on the circumstances. The other thing is C corporations. C corporation, if somebody has a C corp, a lot of times they want to sell the stock so they don't get hit with a double taxation. Or they want to sell the stock because under IRC 1202, they might be able to have to pay, 0 on capital gains. And so there is, or maybe only have to pay a tax on 50% of the capital gains, depending on when their business entity was established. So IRC section 1202 has some very favorable tax laws for C corporations, but they either need to be sold under a stock purchase agreement, or I learned this from Monty Walker, which some of you guys know. But Monty said you also can do you can use an asset purchase agreement as long as the entity does a liquidating distribution immediately following the closing of the sale. So the corporation, it doesn't necessarily have to be a stock sale, but there are a lot of CPAs that don't know that you can actually do it as an asset sale with a liquidating distribution.
And
So
in a situation, oh, this is really helpful. This is fantastic. Thank you. But so let's say we have a buyer coming in and says, "Hey, I want to buy this is going to be a stock sale," and he comes in or she comes in and they've got this 20-page contract for the purchase agreement.
yeah,
Do we say, "Wait a minute, stop everything"? We have our own forms through Ladego. And do we just say, no, we're not going to accept this contract? We
no.
have our own contracts.
No, I mean, so if they're coming in with a 20-page purchase agreement or purchase offer that's already been drafted, I mean, at that point, you're giving that to the seller and just saying you need your attorney to review this. I mean, but
Okay.
I wouldn't ever Now if somebody submits an LOI and you look through it and you can see that it's something that they cut and paste from different things out on the internet, and because there are certain clauses that contradict other clauses and it makes no sense and it doesn't flow, then at that point you can say, hey, you still present it to the seller, but if it's an LOI non-binding, right?
Yep.
Then you're going to tell the seller, hey, there's a couple ways we can counter back to this. Instead of countering back to this in this kind of discombobulated thing that they've
Put
sent to
together.
us. Yeah, we'll use a cab LOI form to counter back to them, and you counter back using the cab LOI. So there are ways to do that, but if it's an actual purchase agreement, then it's a binding agreement, and you don't want to basically tell them, no, you have to do it on our form, because the odds are they had an attorney draft it for them, and it's going to not be a good situation. And the attorney, at that point, you just have to get
Tell
it
them
over to the
yeah,
seller,
tell
but
the
tell the
seller.
seller,
Yeah.
you really need to have an attorney review this before you agree to it, because this is a binding purchase agreement.
And the seller comes back and says, you know what, I don't want to spend $5,000 having an attorney review this. What's the next step at that point? We had a similar situation. I say this because we had a similar situation where it was a self-storage facility.
Yeah,
We actually got, we closed the deal, but um it ended up costing the seller almost 8 grand out of pocket
yeah,
to go back and forth with all of these, and the seller was just getting so frustrated
right.
with the whole situation. Is there any way of sort of like circumventing that whole process of this sort of like, frustration, cash outlay for the seller, or just no, just go with the flow? And
Well, I mean, it depends. It also depends on the size of the transaction. So, if you're talking about a transaction that's, a couple $100,000, and somebody submits a 20-page purchase agreement for it, then I would sit down with the buyer, if unless the buyer is represented by somebody else, and just say, hey, look, this is going to be a problem. And I really would like to be able to put this deal together for you, but your attorney did kind of went overboard on this. This is way overkill for this size of a transaction. And I'd really rather put it on. I always explain to buyers and sellers that the reason we like to use cab forms is because they're neutral, they're balanced, they don't favor buyer or seller. And
yeah,
so it's much easier for the seller to see and understand what's being changed, because they know the form is neutral. So if the attorney adds a 5-page amendment, we know exactly what's being changed. We look at the terms of the amendment, and it's usually trying to put their buyer in a bubble with zero risk and zero liability.
yep.
And so that's the other thing that I tell them. It's like, buying a business, there's inherent risk in buying a business. And if you're not willing to take on that risk, and you need your attorney to put you in a bubble, there's no way this transaction's ever going to get completed. So,
I have a question, but this is on another subject altogether. So that was really brilliant. Thank you, Tanya, as always.